Good evening, everybody. My host, can you hear me? Good evening, everybody. Can you hear me? Good evening. Good evening, everybody. Can you hear me? Okay. Not to waste your time, let's kickstart today's lecture on Zoom. Thank you very much for joining us. This is FCA platform. Well, Zoom lecture for December diet. Wish you all the best of luck. I hope you can all see my screen. I hope you can all see my screen. Okay. I don't know who is my host for today. Okay. Now let's take. Yes, my host. Who is my host? I can't hear you. Okay. Now let's take question on PEP. On January 2015, we have to start with simple group. This is just a revision class where we solve questions.
I can't see your screen clearly.
Obadeswa, your voice is not clear. Let me shout you. Your voice is not clear. I'm shouting you now. Can you hear me? Okay, thank you for that confirmation. No, okay, let's start with this simple group. Before we have to solve question, please follow me. You will get it. I've sent this soft copy of the solution and question to your platform. And I believe by now, you should all have your question and answer with you. Okay? You have your question and answer with you. But don't worry, we will do justice to it. You get what we are saying very well. Okay? Now, let's start with PEP PSC. When I'm giving just a question in exam, what is my own duty to do? If I'm giving this kind of a question, a simple group, please, I believe okay, I believe don't play with all these simple group and associates, including fellows auxiliary. Don't be surprised because I can also know that the time is limited. They might just say, okay, let's give them something simpler to do. We are just saying we don't know. Irrespective way, God will help us in this diet to give us the strength to be able to put through in this diet. Okay, let's say on January 1st, On January 1st, 2015, Pearl PLC acquired 75% of equity shares of. He has told me he acquired 75% of equity shares. That means PEP is a what? A parent company, while More is a subsidiary. Okay. Then the acquisition, they said, share by means of immediate share exchange of 2 shares in PEP for every 5 shares in More. They told me that he acquired 75%. That is enough for me to open everything. But before you open everything, you must read through the question so that there was no disposal. In case there is a disposal of subsidiary at the end of the year and you have opened everything, you are still going to close everything. What do we mean by open everything? Is that you open the name of the company, PEP, PLC, you write that. You will now say consolidated financial statement. Consolidated financial statement. As at so, you put the heading. Then you say PPE of the parent plus that of the subsidiary, you open it. You add it like that, don't go to the information yet. Financial assets, 11,500 plus 6,000. Then you open goodwill account. After you have written your goodwill, please leave 2 line space. Leave 2 line space. We know what can come there, but there is no way the question can carry that too. Then we go to current assets. I also do the same thing. Inventory of the parent plus that of the sub. I go to trade receivable, the same thing. All the necessary accounts required to balance the accounts. Let me show you what I'm saying. All the necessary accounts required to balance the accounts, I'll open it. I need group structure. Adjusted return of subsidiary. As per the SOFP, I'll pick. Determination of net asset of subsidiary, I'll pick. I'll open goodwill calculation, write the formula, cost of investment, add NCI, purchase consideration. I'll write, I'll open return of the parent, NCI value at DOC, I'll open it down. Then all my working. That is what I need to balance the accounts. So I'll open all those ones down. Now, I haven't done that. I will now go to, okay, I will now go to the question properly after I've opened everything. Then I will now start reading. Said he acquired 75% of More equity shares. Group structure has been given. Parents, 75. NCR, 25%. Share by means of immediate share exchange. 2 shares in PEP for everybody shares in More. Okay? We all know that when it is share consolidation, the standard says it must be parent over subsidiary. It must be parent over subsidiary. It must be parent over subsidiary. Okay, it must be parent over subsidiary. I will now ask, okay, it must be issued at the market price by shares of the parent. How many percentage of shares? 75% what he bought. That 75%, what is the numbers? What is the numbers of shares that make up the 75%? I will do the work in I say the total numbers of shares. When we are talking about group accounts, we're only talking about shares acquisition. He bought shares. When we are talking about the percentage of shares he bought, that means he acquired 75%. How does he pay for the 75%? They told me that it's what? Through share consideration. Share consideration can only come out in exam in 3 ways. 1, say issue direct, that is 1. 2, market capitalization. 3, exchange ratio. This one is exchange ratios. In market capitalization and issue direct, they are similar. We are still going to do something like that in sub when we get there. We shall cross the bridge. But today we are dealing with what? Exchange ratios. And they give you how the exchange ratio, how they exchange the shares. Always know that it's parent over subsidiary. I will now go to the share capital of the parent to know how many shares does he acquire that make up the 75%. Let me show you the calculation. This is date of acquisition to date of consolidation is 6 months. We know that from what he has given. Total numbers of shares in subsidiary equals to values of shares divided by the nominal value. Why am I saying 20,000 naira? We are only talking about share capital only when we are talking about group accounts. I'll go to the share capital of who? The share capital of the subsidiary. Let's go to the share capital subsidiary and see. Look at the equity shares, subsidiary 20,000. This is the value, the book value, not the current value. The book value as the nominal price of 1 naira. The share cannot be sold at 1 naira anymore. But when it's sold it, when they issue it or float the company or something, they have a nominal value of what? 1 naira, 20,000 naira. I will now convert it to what? Unit of shares by saying total numbers of shares. By saying total number, this TNS means total numbers of shares in subsidiary equals to the values of shares all over nominal value, which is 20,000 divided by 1 to give me 20,000. Then parent shares acquire 75%. 75% of 20,000. 75% of 20,000 is 15,000, not 16. It is 15,000. Then how many costs of investment do they use in the question? They use share consideration. So I will now say for the share consideration, it is PEP over more. How many is the PEP bringing? 2 over 5. 2 over 5 times 15,000 will give me 6,000. I will ask the question. The share must be issued by the market price of the parent. It must be issued by the market price of the parent. If you give me that of the parent and subsidiary, don't use the sub. It must be parent because the parent is one acquiring and he does not have money to pay outrightly, cash. He now uses his own shares to pay. And if you go to the question, let us go to the question. If you go to the question, look at the question. The question specified to us say the fair value of PEP among shares on January 2015 we have 4 naira and 3 naira. So the market price per shares of parent, which is PEP, is 4 naira. So the share must be issued at the market price per share of 4 naira. I will now go to the question. No problem. The market price per shares 4 naira. I will now say the 15,000 times 2 over 5, which gives me 6,000. 6,000. So this one will go to the cost of investment to be debited. 24,000. Then equity shares to be credited, which is 6,000 times 1 naira. 6,000. I will credit it. Then he has created a premium. He issued it at the market price of 4 naira, and the equity share is 1 naira. 4 minus 1 times 6,000. It will give me 18,000. Or I will just remove the rest, 24,000 minus 6, because it is 2 credits in case 1 debit. 24 minus 6,000, it will give me 18,000. So the next question, I will ask this question. Has it been recorded as the accountant in the company posted? The question will tell me, or I investigate further. Let me see. You will see. I will ask the question. Let me read to know whether it has been recorded. I said, in addition to the share exchange, PEP will make a cash payment of 132 kobo per shares acquired. Divided on 20, but PEP has not recorded any of this consideration. He has not recorded any of this consideration. None of the consideration has been recorded. Good. Said none of this consideration. That means even the share consideration has not been recorded. So I know the accounting entry when it's come to what? Share consideration. Let's go. We have say cost of investment, debit or the goodwill calculation, equity shares credit, share premium credit. So look at it. I will now say, okay, it has not been recorded. I'll post immediately. How do I post? I go up, I've opened the account down already. I say, okay, the share cost of investment for goodwill calculation. I will debit it for goodwill. Equity shares, look at it. He does not have share premium in the question, but he has other component of equity. Other component of equity means, okay, others, including share premium. So I don't bother myself open share premium account because he has other components of equity. I will now say the 4,000 plus the share premium, because when we are crediting the reserve, we are adding to it. That is what it means. Then 20 plus 6, the equity shares. Then the other one will go to my what? Goodwill calculation. The cost of investment for my goodwill calculation. For the goodwill calculation, cost of investment. Let's sit down. Oh, for the share consideration, 24,000 naira. Go to my goodwill calculation. But it does not only use that one. He also used a deeper consideration according to the question. He said it's going to be deeper until said it's going to be deeper. Let's see. For the deeper consideration, he also used deeper consideration. Now, let's see to know whether it is deeper consideration. Let's go there. You will see what I'm saying. Said, okay, in addition to the share exchange, in addition to what he has paid, PEP will make a cash payment of $100 per shares acquired, delivered until 1 January 2016. Is paying date of payment. Don't forget, date. I always tell people, when you see deeper consideration, let your eyes ball open. Come, there will be a trap of interest, just like this conclude diet. They set, they give them deeper consideration, they give them contingent, and they give them cash. The deeper consideration, the interest element. If you look at this question, we acquired on January 2015. When are we consolidating? Said we should consolidate in 30 June 2015. Consolidate in 30 June 2015. That is 6-month account. 6-month account. I will open my eyes when it is paying, date of payment, deferred until 1 January 2016. It's paying in when? In a year, because he acquired in January 2015, it's January 2016. That means it is 1 year payment. But they asked me to consolidate for 6 months. This is the trap that is always in deeper consideration. This is the trap that is always in deeper consideration. This is the trap. This is the trap in deeper consideration. This is the trap in deeper consideration. This is always the trap in deeper consideration. So always remember that, the interest element. But what am I going to do in exam? It is very clear for me. I'll get the present value. After getting the present value, I will go over the interest. Okay, let me show you the visual. You all know how to get the present value. You said the present value equals to visual value, bracket 1 plus half raised to power minus n. It's not n. Raised to power minus n. If you don't want to put minus, that means the visual value divided by 1 plus half raised to power n. From the law of indices, you always remember when you are doing your mathematics in your secondary school days. But what is the visual value? He said he's going to pay 1 naira 32 kobo per shares. Okay, times 15,000. It will give me what? 19,800. That is the visual value. At what rate? They've given us in the question. Dates at 10% cost of capital, 10%. And the numbers of years from the date of acquisition to date of payment is 1 year. From date of acquisition to date of payment is 1 year. So I will now put it to the formula by saying the present value equals to 9,800, which is the visual value, bracket 1 plus 0.1. It will now give me 19,800, bracket 1 plus 1.1 raised over minus 1. After putting it into my calculation, it gives me the present value of 18,000 that will be debited to the cost of investment. Then the interest element. The interest element, I can get the interest in 2 ways. Say the visual value equals to present value plus interest. The visual value equals to present value plus interest. What is the future value? 98,800. The present value is 18,000. I collect the lifetime, I'll get the interest of 1,800. The interest of 1,800 is for one good year. This is for 1 year. I need the interest element of 6 months because I'm consolidating in 6 months. Always remember, when you are giving deeper consideration, look at the date of payment. Look at the date they ask you to consolidate. They will always be deeper because they will not give you a cheaper question like that. So you want us to know that I need interest of how many months? 6 months. I can calculate my interest in another way by saying year one, what is the present value? 18,000. 10% of 18,000, 1/8. Closing liability, 1/8 plus 18 will give me what? 19,800. But consolidating for 6 months, I only need interest of 6 months. I will now say 1,800. I have no interest of 1 year. Then I can know the interest of what? 6 months. That 1,800 times 6 over 12 will give me what? 900. We know the accounting entry. Present value of the cost of investment must be debited for the goodwill calculation, which is 18,000. Retain any of the parents. Retain any of the parents must also be debited. That means the finance cost must be debited to the parents account. Is the one that is going to suffer the finance cost, the unwinding interest of 900. Then liability of current liability, 18,900. Some people said you can open a contingent deeper consideration. Why mean that? That is not part of our trading activities. No problem. Always your way, but they will see market for you because it's going to be payable under 1 year, 18,900. So this is accounting entry, and he said it has not been debit, it has not been recorded. Don't forget, the question says the two costs of investment has not been recorded. I will now go to my financials that I've opened. One will go to the cost of investment, look at it for the deeper consideration, 18,000, debit to the cost of investment. Then the return of the parents, I've opened the account now. As per SFP, I've put it. I will not debit the return any. Look at it. The return of the parents must suffer finance cost 900. If I'm debiting return any, I'm minusing from it. If I'm debiting return any, I'm minusing for it. Then the liability, I go to my trade payables. I had is paying under 1 year, 18,900. This is the trade payable, 18,100. The parent account, the parent first, then plus the sub, plus 18,900. That is that on the cost. Before we go further, please, any question? Before we go further on this, please ask me. Drop your question. Let me attend to it in the next 3 minutes. I don't want the question to pile up. So please, you can drop your question within 3 minutes. Let me attend to it within 3 minutes. Please, let me attend to it within 3 minutes. In case you have any question, please, you can shout me. You can shout on the platform. Shout on the platform. Then, oh, sorry for that. He says, sir, please, you are too fast. I'm not understanding. Sorry, Rabia. I hope the pace has been reduced. I hope the pace has been, is because, okay, as you explained, Rabia, you can also notice that the pace has reduced. If you are still not comfortable with that pace, please quickly say so that I can adjust to my pace. Thank you very much, Rabia. Then you say, okay, please explain the interest again. Good. Then where do I? Okay, we are just, that one says, we are still coming, we have prepared the account. We have prepared the account already. Don't worry, you will see where the 1/6 come from. I think it should give you in the subsequent additional information. Okay, you are talking about this 1/6. It will still be in addition subsequent information. We have not done with the question. So, but he said the interest element. I should explain the interest element again. One of it I should explain. Now, what is who saying about the interest element? If you look at the solution I've given you here, the solution I provided to you on deeper consideration, The interest is for 1 year after you have gotten our present value. The question asked me to consolidate for 6 months. How do I know I have to consolidate for 6 months? Based on the question, let's see, from January 2015 to when am I acquired in January 2015, then I'm consolidating on 30th June 2015. On 30th June 2015. That means from January 2015 to 30th June, that should be 6 months. Nobody say you should not count hands in exam. Because January inclusive, because it starts from January 1st, February, March, April, May, and June was also inclusive, June 30. That means I'm only consolidating for 6 months. I'm only consolidating for 6 months. I'm only consolidating for 6 months. Okay, no problem. If I'm consolidating for 6 months, good for me. If I'm consolidating for 6 months, that means I need the interest of 6 months. And they use deeper consideration. Don't forget the date of payment is 1 year. 1 year. Because look at when they say he wants to pay. Pay will pay, make a cash payment, partial acquire, deferred until 1st January, and acquire in January 1st to January 2016. That is 1 year account, 1 year payment. But I'm to consolidate in 6 months. So I'll get the present value of that amount. He acquired 50,000 shares. That's 100 to give me this. Then the 10%, I will get the present value. Then I will not get the interest of 1 year. There's no way I can get interest of 6 months. I can only get the interest of 1 year, they prorate it times 6/12 for the finance cost. So 1/8, which is the interest of 1 year, times 6/12. But I'm consolidating for 6 months. That means 1/8 times 6/12 will give me 900. Where am I going to debit and credit? Present value, cost of investment, debit. For the present value, 80,000. Return of the parent, debit, and current liability, credit. And he has not posted any of these transactions. It has not posted any of these transactions, which I will do justice to that. Okay. Let me see if I can take one more question. Okay, Rabbi, I think I've recapped the deeper consideration. I think I've recapped again. Thank you. So let us move on. Let us move on, please. Now let us go to the question again and see. Okay, yeah, the question again. So all information here has been used except one. All information here has been used except one. In exam, this is how they set question on group account. These are the set question on group account. The first part of the question will be on the cost of investment, details about the acquisition, while the second aspect will be additional information regarding to the adjustment. If you look at all the question on group account, this has been the process, because there's no way you can know how much he paid unless he tell you to do that. So, okay, thank you, Rabiat. Thank you for that. If you look at this question now, he said, oh, there's one thing that I need to take care of. This is where 3 naira. He gave me 3 naira of the subsidiary, the market price per share of the subsidiary. He said it is 3 naira. With this information, my head will fly. That means this account is at fair value. This account is at fair value. That means NCI is value. What I mean by this at fair value is NCI is value at fair value. It's an indication for me that NCI it is value at fair value. Because according to the standard, he said, how can NCI be value? NCI can only be value in 2 ways. He says it is fair value and share proportionate. Don't forget, fair value can also be called full goodwill method. Then share proportionate. It can also be known as what? Net asset method or partial goodwill. Okay, no issue. I will not confirm it. So if it is fair value, one of these must be in the question to indicate to me it is fair value. One of these four. Please take your pen if you have not known that before. One of these four must be inside the question to indicate to me it is fair value. One, unless the questioner said contrary to that. Now say one, market price per shares of subsidiary or NCI will be given in the question. Market price per share of subsidiary or NCI will be given in the question. That is one, which will indicate to me is fair value. That is one. Two, they will give me the fair value of the whole company, of the whole subsidiary. They can say the fair value of more shares, the fair value of the whole more as a whole, as a company. They will give you the value where you now multiply the percentage on the whole. Third one, they can give me fair value directly from the question. They will give me fair value directly from the question. And then the fourth one, they will give me goodwill attributed to NCI. They will give me goodwill attributed to what? NCI. The goodwill attributed to NCI. That is before one of these four must be in the question to show it is fair value. Now let us go there. Let us go to this question to see what it is fair value, whether it is fair value. Okay? Because it has given market price per share, it's an indication. I will now go to the additional information to confirm whether it is fair value, whether it is fair value. Oh, look at additional information 6. It says the non-purpose is fair policy to value not controlling interest at fair value and at date of acquisition for this purpose, more share price as that date is representative of the fair value of shares held by the non-controlling interest. They don't need to tell me this. I should know already. Why? Because the shares of NCI cannot differ from that of the parent. The market value of the shares, the same price they will carry because they're in the same company. So I will know without saying that. So anytime you see market price per shares of subsidiary or NCI given in the question, it is an indication it is fair value. So I will not miss that part. I will not go miss that part. Again, I'm okay, you have given me the market price per share of 3 naira. What is my own duty now? Market price per share, 3 naira. What is my own duty? I can determine the NCI. Don't forget the total numbers of shares is 20,000 and the 75% was acquired by the parent, which is 15,000. The remaining share that belongs to NCI, the unacquired share by the parent, which is 5,000, times the market price per share of 3 naira. 5,000 times 3 naira will now give me what? 5 times 3 give me 15. That means NCI is what? 15,000. I will not miss. That means I've finished all the information regarding here. I will not go back to it again. I have finished all the information regarding this place. Therefore, I don't need to go back here again. Now, see the solution of what I'm saying. NCI, let's go to the goodwill calculation. NCI at fair value, 15,000. How do I get the 15,000? Let me see. How do I get the 15,000? The value of NCI at date of acquisition, 20,000 times 0.25 times 3 naira, 15,000. With that, that is the first part is gone. I'll just put it in my goodwill calculation. Then I'll go to the next one. I'll go to the next one. 15,000. The cost of investment, the share consideration, and the deferred consideration, the total amount, I add it together, 42,000. Plus the value of NCI, 15. That one will give me my purchase consideration, 7,000. Now, look at it here. because of investment. This is it. Plus NCI value. On that note, I will now go to the additional information. On that note, yes, they say more business is seasonal and 60% of annual profit is made in the period of 1st January to 30 June each year. The business is seasonal. Good. More business is seasonal. No story. We are still coming to there. Why did they give me that? Anytime ICANN is setting otherwise profit, because it is doing the acquisition, no retail earning will be given at the date of acquisition. We have to calculate. The question the news says if it is, it we assume, the standard says we assume that it is on even basis, that is profit or loss and expense and every other thing accrued to the company on evil rates. That means the profit or loss can only come in evil 2, 4, 6, 8. You cannot say 5. That I will not put it to give me decimal. That is what the question, the standard says. He now said, unless it is otherwise stated, and this question is otherwise. ICANN has not tested otherwise again. In just ICANN has not tested doing the acquisition in professional level. But it has been tested so many times in ACCA final level, doing the acquisition. That is why we are taking towards that direction that this can also be done. Okay, but let's see leave that information one. I will show you how it is done so that you can see. Okay, let's go to additional information two. At the date of acquisition, fair value of money assets were equal to the carry amount with the following exceptions: fair value adjustment, fair value exercise at the date of acquisition. In no question on group account, this one must be there. Fair value exercise. It must be there. Now, how do I go about it? There's only two ways fair value exercise can come. It is either you are revaluing up, revaluation surplus, or you are revaluing down, revaluation deficit. That is only two ways. But in exam, how do I know it is surplus? How do I know it is deficit? If it is surplus, these are the three ways to know. It's the same way to know deficit. The question will tell you categorically above, upward, in excess, higher than the carrying amount. They help you compare the carrying amount, they will give you the excess direct. That is one way. If it is deficit as well, you will hear in the question. The question will state it categorically, downward, upward, below, showing it is deficit. Or the second one, they will give you the fair value and the carrying amount. The carrying amount first, they will give you the fair value, the carrying amount of the asset and the fair value. You will not compare yourself to know whether it is surplus or deficit. If the fair value is greater than the carrying amount, the fair value now is greater than the carrying amount. Fair value means today market. It's not greater than the one in the book value, which will give you surplus when the fair value is greater than the carrying amount. But if the carrying amount is, we only need the differences. If the carrying amount is not greater than the fair value, it will give me deficit. They are opposite each other. Then the last one, giving directly from the question. In such a way, you will see they will write it one line word. fair value of PPE. They will not give you the carry amount. They will only state the fair value of the PPE. You will now go and compare with the carry amount in the book. PPE. You can say fair value of the asset is 30,000. You compare it with 28,600. You will now compare with 28,600 to know whether it is surplus or deficit. That is the only way. That's those ways the three can come. Now let us now look at this question. Which one is he asking us? Check. Item of plan had a fair value of 2 million below the carrying value, below deficit. That means my reserve, the net asset at date of auction should be subtracted by 2 million below the carrying value. Why am I going to debit and credit? That means the PPE is overstated in the book. I will credit the PPE minus 2,000. I will debit the reserve. That means the net assets. I will debit it minus 2,000. Let me show you the solution and the debit entry. Okay. Additional information 1. Revaluation deficit of 2,000. PPE, I will credit minus 2,000. Reserve, debit 2,000. Look at it. This is minus. Is deficit. That should be minus. It's typing error minus. Then this should be plus. Let's see. Because it's below. It's below. When I'm crediting PPE, it's minus. So if you do it, you get the final answer. It's minus. Typing error. Then depreciation part of it. Depreciation. Because I'll be overcharging myself initially. I will now say depreciation 2,000 divided by 2 because they've given me useful life of the assets at the date of acquisition. 2 million. The date of acquisition, it had a remaining useful life of 2 years. 2 years. So divided times date of acquisition to date of consideration is 6 months, 500. What do I do? PPE must be debited plus 500. The PPE must be debited plus 500. I will not credit adjusted retain any of the subsidiary 500. I will credit adjusted retain any of the subsidiary 500. Because he has been overcharging himself, I will take it back. Because he has been overcharging himself, let's go to, you can see depreciation, credit 500. Actually, I will not add back to the PPE. So please correct this. This is minus plus. And if you do it right, 52,000 plus 28 minus 2,000 plus 500, it will give you this figure, not the other way around. You can test on it. Please, sorry for that. So always remember, if it is deficit, I will subtract from the PPE by crediting PPE. Credit the PPE, I will subtract. Then the depreciation, I will add back if it is deficit. But if it is surplus, it's opposite. PPE debit, then the depreciation minus because I'll be undercharging the decision. Then I just tell retain, I'll go and remove the money. That is first one. Then the additional information one has not concluded. Additional information one has not concluded. The fair value of money investment was 7 million. The fair value of money investment was 7 million. It says see also note 5. The investment was 7 million. What do I do? They did not give me the carrying amount. This is what I'm telling you. The fair value of money investment. What is the carrying amount? To know whether it is surplus or deficit. I will now go to the PPE. Go and look. I'll go to the investment, financial assets, 6,000. But he has in his book value 6,000. And today, it has, as at the date they are acquiring, we value the investment to be 7 million. That means there is increase in investment. Increase investment of how much? 1,000. Is the increment, like the way we have done for the surplus. I'll go to the net asset. I will go to the net assets. I will add the increment by crediting the increments in the reserve, and I will debit the financial assets by 1,000 to make 7,000. Look at it. Increase in investment, 1,000. I will now go to the financial assets to go and add the 1,000 plus 1,000. He also say, see note. Let's go to the note he said, you see how we should see. He said, see note 5. Let me go to note 5. See note 5. Look at note 5. Say, on 30 June 2015, the fair value of the financial asset, the equity investment in paper more, we are now 13.2 and 7.9 as at the reporting date. But as at the date of acquisition, it has increased by 1,000 to become 7,000 at date of acquisition. What he has before is 6,000 before the parent took control, and they now value the investment to be 7,000. That means there is increment of 1,000 to the investment. They now said, as at the end of the year, they should do the fair value exercise for both the parents and the subsidiary. They note that the parent owner has increased to 13.2. That means he has made gain on investment. It was not impaired. He appreciates. I will now go to the look at it. What is the financial asset? 11.5. What is the gain on investment now? 13.2 minus 11.5. That of the parent first. I will debit for the difference, 11.5, to make it 13.2. Then I will take the gain to the parent account because it's the owner of the asset. Look at it. Look at the parent gain, 13.2 minus 11.5 plus that's increased. If you add 1.7, these are the reporting date. 1.7 plus 11.5, it will give me 13.2 at the end of the reporting period. That is the value. I will not credit, I've debit the financial assets. I will not credit parents' account for the gain on investment, 1.7. Then for the subsidiary, is look at the subsidiary owed according to the question. The subsidiary owed, he said, the investment at date of acquisition has now become 7,000, but it has increased further by how much? Let's go to information 5. As 30 June 2015, the fair value of financial assets including investment in paper more now is now 79. Don't forget at this option we have had 1,000. It has increased further by how much? 900, because it's now 7.9, which is 7.9 million. 7,900,000. 900,000 has increased again. I will go to my financial assets, increase it by 900. Increase it by 900. The financial assets. Increase it by 900 plus 900. It happens at the date of consolidation. I will now go to the net asset date of acquisition. It has become 19. 19 minus 1,000 will now give me the post. What is the post? 900. 900 should be shared. You will see it when we are sharing the investment. 900. Share of gain, 900. When I type omit down 900, is 0.75 times 900. Share of the post. At date of consolidation, it has grown from 1,000 to 19. So that is it. So date of consolidation, I will add 900 to it to make one, and that will give me post of 900 to share between the parent and next year. I will now go to the financial assets. Go and do the same thing in the financial assets plus 900. That is that. Before we go to the next one, additional information. Ask question, please. Ask question. Thank you. As I said earlier, they have not brought simple group like this. But the basis to start any question in group account, you start from the simplest. Even this is not simple, we just moderate it to bring this. Then from there, we start open it wide by saying, well, from simple investment, you go to the one with associates, which they regularly tested. From associates to different type, fellow subsidiary, sub, D-shape, disposal of subsidiary, piecemeal acquisition, and co. Is the 19. The me is the 19. Now, the date of acquisition, before the date of acquisition, the investment was carried at 6,000. Plus, it has grown at the date of acquisition, the value to be 7,000. We had the 1,000. At the reporting date, it has now become 79. If you add everything, 6,000 plus 1, 7,000. Plus this, 900, 79. It has increased from the carry amounts before the date of acquisition. At the date of acquisition, it becomes 7,000. At consolidation, it becomes 79. This is it here. And that of the parent too, it becomes 13. So everything is done here. Yes. A minute after this class, I will send the audio to this. Please recap what Madam Rhoda. Okay, we said one, if it is fair value, market price per shares of subsidiary or NCI will be given in the question. Either they give you the market price per share of the subsidiary or NCI because they will always have the same value. In a subsidiary company, that's one. Market price per share of subsidiary or NCI will be given. One. Two, fair value of the whole company. They can tell you that the fair value of more is 5 million. And it does not acquire everything, it only acquire 75%. That means 25% is for NCI. I will now say 25% times 5 million. The third one, fair value, they can give us directly from the question. Then the fourth one is the goodwill attributed to NCI. We are still going to apply all the four before you go for the day. So that is that. Let's go to additional information next. Now, if you go to additional information, C, more own the right to a popular mobile cell phone game. At date of acquisition, a specialist valued the estimate that rights were worth 12 million and had a remaining useful life of 5 years. It happens at the date of acquisition. This happened at the date of acquisition. Therefore, it happens at the date of acquisition. No issue. I will debit the brand name, then credit the reserve for the 12 million. I will amortize just like the surplus. Amortize it based on the useful life of 5 years. Don't forget we are only consolidating for 6 months. I will now say, okay, no problem. The 12 million, let's go to additional information 2. This is additional information 2. Brand name at the date of acquisition. Brand name account will be debited 12,000. That's why I say if after the goodwill, leave 2 lines. It's not possible to see whether I will carry everything. There's maximum of 3 things that can come there, and question can only take 2. So I will not credit reserve. Look at what we are saying. Where is my reserve? Brand name, 12,000. I will go. Open a brand name account, 12,000. I will amortize. Amortization is a pure item based on the useful life. I will now say, okay, 12,000 divided by 12. Times 6/12, which is 1/2. I will now credit. I will credit. Not at the accounting entry. I will credit it, the brand name, for the amortized figure, 1/2, to remove 1/2 from it. Then I'll go to the adjusted retained, remove 1/2 in his account by debiting it. Of who? Subsidiary, which is the owner of the asset. I will debit his account. Amortization. I will now go to brand name, remove the 1/2, plus 1/2. That is that. Then I'll go to the next information. Following an impairment review, consolidated goodwill is to be written down by 3 million. I know when it is fair value, the goodwill belongs to both the parent and NCR. Don't forget, when it is fair value, the goodwill belongs to both the parent and NCR. And the goodwill of the parent, even in fair value, is share proportionate because the standard make it clear. Anything he pays above the net assets, it is goodwill. Anything he pays above the net asset, it is the goodwill of who? The parent. That means if he bought 80% and the total net asset is 3,000, 80% of that 3,000, it is from what he bought. Anything he pays above that, we will give you what? The goodwill. That is what he's saying, that in any certain condition, even in fair value, the goodwill of the parent is sure proportionate. Immediately you know this one, good for you, because when we get to disposal, when we get to cash flow, you will see how this thing come to play. You will see it in the question. But because we have known all those one before, there will not be issue. Okay. So, and it is fair value. That means how they will share the goodwill, the impairment based on the parent and NCR. Although I have not determined the net asset, I can share the impairment between the parent and NCR so that I will not forget before going to the next one. I will now say, okay, impairment. 75% of it will go. We will have, I will now say impairment. 75% will go to the parent. NCR will take the remaining one, impairment, 750. That means it's 0.2553,000, 750 to debit. I've written the formula out. I will just put in the formula of the goodwill because I've written it out already. Goodwill. I've written out. I will just put this is what I've done. I only know the cost as but I've written the formula out. I'll just say impairment 3,000. It means I've not known the purchase, I've not known the net asset. But because I've written the formula out, I'll just set it 3,000 so that I will not go back again to that impairment. Having said that, don't forget when it is fair value, the goodwill belongs to both the parent and NCR, and NCR will also suffer when it is impairment on its goodwill if it is fair value. The next one is PEP sell goods to more at a cost plus 30%. PEP had 1.8 million of these goods in inventory as at 30 June 2015, which has been supplied by PEP. In addition, on 28 June 2015, PEP processed the sales of HNS goods to more, which more did not accounted for. They used to sell this thing up to last night. It was tested. Even the one on transit, it must have marked it up by 30%. Unrealized profit on inventory. It can only come in two ways in exam. I think you can only see it in two ways. That means you can determine if there's unrealized profit on inventory in two ways. By saying, is there element of profit? And it's what? The next one, is there unsold? Somebody has not sold 1.8 million to finish. You process another one, you sell. That means the two are unsold. 1.8 that's on the way, plus 800, making 1.8 plus 800 will give us what? 2,600. That is the unsold. And he has marked it up. How do I know there's element of profit? You will hear markup, margin. Markup is on cost, margin is on sales. And the formula one, which you are going to do before you go, for example, on group accounts. the Formula One. I will now say, okay, no problem. 30 over 130, 30%. I will add, because it's markup, 100 plus 30, making 130. That is the unsold. What is the unsold now? 18 plus 800. We now say, okay, because that one is not even sold. Anyone that is processing again, he must add it to it, the markup. This is the unsold. Total unsold now. One is because the one is said that it's on transit, he must have add markup on it, 800. This is 130. We now give me 30 over 130 times 26. It will give me 600. 30 over 130, not 150, times 26, it will give me 600. It will give me 600. What do I do? Debit the retain any of the seller. Who is the seller? Ask yourself. And credit consolidated inventory. Irrespective of the seller, where the second leg is going, consolidated inventory must be credited. So I will go to the inventory and credit it. I'll go to the inventory and credit consolidated inventory and debit the seller. And the seller happen to be who? Parents. Because PEP is the one selling. Unrealized profit on inventory. If subsidiary is the seller, go to his account, adjusted return of subsidiary, remove the money. Then I will now go to what? Consolidated inventory. Where is the consolidated inventory? Minus 600. Credit. That is what it is. Now, because I want us to solve associate today so that we know we have finished simple group. Let's go to the next one. But the question was not finished. The transit recognition should be received. Okay. The in-transit recognition should be achieved by assuming transaction has been recorded in books of PEP. The seller definitely must have recorded it. Even before the goods leave the company, they must have passed entry before the year ends. At 30 June, PEP had trade balance of 2.4 million due from more, which differ to equivalent balance in book more due to the sales made of there is inventory in transit, trade payable, trade receivable reconciliation. It's only three ways it can come in exam. Let me show you the three ways it can come. It's only three ways it can come in exam. Let me show you the three ways. I've written it down. One of them is transit. That is what it's saying. One of them is the what the question gives us. And is that one the question gives us is the most tested. It is what they test last night too. Okay, trade receivable, trade payable reconciliation. The first one, they both agree to the owing. Parents and subsidiary agree to the owing. Parents says, subsidiary, you are owing me. Subsidiary reply, yes, they agree to the owing. They will tell you in the question, it agrees with the corresponding balance of the other party. That means if it is parents will say you agree with the subsidiary that the money is. Don't owe each other from the definition of the group account. Don't owe each other because it's the account of the parent and subsidiary. Prepare and present it as if they are one. So you cannot owe yourself, it must be eliminated. I will now say trade receivable, credit by minusing it. Trade payable, debit, minus it. When they agree to the owing. But total cash or inventory in transit, no parts now. Total cash. Say you are owing me, say I have transferred the money yesterday. Total cash or inventory in transit. ICANN has tested this one once. What do I do? Trade receivable, I eliminate by crediting trade receivable account. Don't owe each other, but he has transferred the money. I will not debit bank, but he transferred the whole money. I will debit bank or cash in case in any of the question. If I'm debiting bank, what am I doing? I'm increasing it back. That is the second way. This is the third way. Parts in transit, like this one. Out of the 24 is owing, 800 is on transit. Don't owe each other. There is no need to do from parent account or subsidiary. We can do that too. But here, there is no need because we are consolidating two of them. Just say, okay, let me pass a journal entry to reflect the parent account. You are wasting time. Sometimes we do that. Which time do you have in exam? Trade receivable. What do I do to the trade receivable? Credit. 24,000. 24. He has inventory is in transit 800. I will debit the inventory by adding to it. How much are they owing? They are owing 1/6. Trade payable, I will now minus. Don't owe each other. Because technically here, they are only owing 1/6. The inventory that is transit, I will add it back. This is what the standard says. Now let us see the post. Minus 1/6. The 1/6 you are asking me before. Trade is minus 24. Plus the inventory in transit, I will debit the interest. 24 minus 800 will give us what? 1/6. It's 1/6 they are owing. Trade payable, 1/6. That is that. With 2.4 million, which is good. So on that note, we have finished the question. That is why if you open everything, it will be very, very easier. I will just consolidate. Before I consolidate, let me use 2 minutes or 3 minutes to answer any question before we go to the next question and consolidate by adding up. Mr. Yusuf Shitu, sorry, sir. Please come again with the PC Goodwill explanation. Sir, please, I did not understand the question you are trying to ask me. Can you please help me reframe? Yes, we have that in this question. We have that, yes, ma. We have that, Madam Adenike. We have that here. Look at it. I sent like 4 questions on simple group. I even sent fellow subsidiary. I think this is consolidated POL, Bola, and it has a contingent consideration. It was cash and contingent. So it means we have treated purpose of investment. That is a deferred consideration, share consideration. This one is contingent and cash. Then we also have another contingent here too. Either PSA is has a contingent consideration because contingent consideration is always tested in professional level. I don't know the reason. Only I can explain. So we have to deal with that very well. Okay. So then after the associate, we go to Barewa PSC. But because of our time, anyone will not be able to go through the solution. You can private chat me. My number is 080 240 340 03. I will still send it to the platform. You can call us anytime. We are here for you to pass. Somebody help us, and we're also going to help others. So that is that. Now I have not seen at this level consolidated change of statement of change in equity. I think it is for FR level. They used to test that. FR level. They used to test that. Mr. Yusuf, maybe what you are trying to say that the goodwill gotten using fair value belongs to both the parent and SCI. Okay. Okay, sir, what I'm trying to say is this, that when it is even a full goodwill method, that means fair value method was used, the goodwill you have gotten belongs to both the parents and NCR. And the goodwill of the parents, even in fair value, the goodwill of the parents, even in fair value, is share of proportionate. The goodwill of the parents, even in fair value, is share of proportionate. That means the goodwill of the parents at all time is share of proportionate, even in fair value. What is the difference between fair value and share of proportionate? Is that the goodwill attributed to NCI, goodwill attributed to NCI is available in fair value, but not in share proportionate, unless it was impairment testing purposes. In the next question, I will use 30 minutes to show you when it is impairment testing purposes. Take one or two questions on that before we start the job of the day. Okay. But on that note, let us consolidate so that we can go to the next question, which is associate. So don't forget the PPE of the parent, add that of the sub. We have gotten our goodwill because we have determined the net asset at date of acquisition. What is the net asset? I will sum it up. The question has finished. I'm running 49. This is the net asset at date of acquisition. I'll bring the net asset at date of acquisition to the goodwill calculation, which is done 49. 57 minus the cost of investment is 42. That is the share consideration and dividend plus the value of NCI. The share market price per share is 3 naira, and we only acquire 75% out of 20,000 units of shares. So the remaining 5,000 belongs to the NCI. We times it by the 3 naira to give me 15,000. Addition of the two will give us 57,000. Then we let the net asset date of acquisition 49 to give me what? Goodwill at the date of acquisition. Then the goodwill to report at the DOC. After impairment, the question says there is impairment of 3,000 naira, which gives me goodwill of 5,000 to be reported. Okay, that leaves me. I will do my adjusted retaining. Adjusted retaining is 24,000 plus the excess depreciation I've been charging. That is the 500 because it's a revaluation deficit. 500. Then the amortization of 1,2. I'll bring that down to give me post of 5,3. If you also look at here, 1,9 minus 1,000 will give us 900, although it was not captured here, but it was captured in the calculation. So you can use when you are printed, use your what do you call it, pen to adjust that place. Then we have got the return of the parent as per statement of financial position. There's one we need to do, one adjustment. We have not, okay, we are coming there now. As per SFP, 52,200. How do we get 52,200? Don't forget, let's go to that number one, adjustment. Let's go to that number one, adjustment. which is to determine the retain at the date of acquisition. If it is during the year acquisition, no retain any at the date of acquisition. No retain any, they will not give you retain any when it is during the year. How do I know it is during the year? When does he acquire? He acquire on January 1st. And they are consolidating. That's the 6-month account. No retain any. But if you look at the retain any given year, retain any as at July 2014, as at the beginning of the year, before it starts anything. For the parent, it was 26. For the year ended, the profit he made for the whole year is 24,000. 26,000 plus 24,000, that is what gives us 50,200 you see in the SOFP. Because the return at date of acquisition plus year ended profit or loss, that is why you see 52,200. Now let us go to the data of the subsidiary. Okay. As at the beginning of the year, before he started, he has 14,000. He has 14,000. For the year ended, he made 10,000. What is going to be in my statement of financial position? 24,000. 24,000. That is why if you go to the statement of financial position, you see it. Adjusted retain 24,000. The two must be added. The pre he has plus the one he made for the year must be added. Now they say 60% of the profit is through the year acquisition. Determination of the net asset at the date of acquisition of the subsidiary at acquisition. From date of acquisition to the end of 6 months. Profit for the year is 10,000 naira. Retain at SOFP, addition of the two. It is otherwise stated, I will operate 10,000 times 6 over 12. But he gave me how he made the profit by saying 60% from June to January, which is the post. I will take the post, retain at date of acquisition TB1, apply the formula by saying retain at date of acquisition plus year ended profit or loss equals to retain at SOFP. I would now say y plus 10,000 times 6 over 6 because percentage will now equal to 34,000. Y plus 6,000 equals to what is now y? 18,000. That is why you see the retaining. This is one of the technical area of the question. Where do I apply this formula? When it is doing the acquisition, we have two alternatives to do it. Before we go to the alternative way. It's only two ways. Look at it. This is one of the technicality of the question. When it is doing the year acquisition, no retaining. When we are doing the year, it will be less than. Now, what is now my own duty in exam? Very simple. I'll write the formula. Don't forget 24,000. Retaining and look at the formula. Plus year-ended profit. What he has been making before, plus what he making this year, must be in the statement of. That's why they call it financial position. ICANN has tested doing the year very well in FI. They've tested when profit is made. They've not tested loss. They've not tested otherwise. Take notes. Can they test? Yes, it's part of the syllabus. Yes. Now, alternative method. This is the retaining at the beginning of the year. Before he commenced operation, they've given me for the year ended. The profit he made is 10,000. But before he voted, this is free at the beginning. Profit from pre-acquisition profit, 40%. 40% times 10,000, 4,000 will give me 18,000. That is it. The two formula, but if you are using this one, it is post. If you are using this alternative, it is free. That is why we get the retain. Retain at the end of our position, that's why we get it. 18,000. So we now share the post. 2, 3 minus 18,000. The post based on the growth structure, parent and NCI. Current and NCI. The 5, 3. This 5, 3. Okay. Impairment 3,000. Then the 5, 3 share post. Then gain on investment. Total 52,800. Out of the NCI, the same thing. Gain on investment, the post. So if I add everything, give me 15,800. Why this one will give me 15,200? So I'll go to the financials that I've opened down and post my figure. Retain NCI, other equity components, equity shares. They're the same thing, PPE, every other thing. I'll consolidate. So let's take 2 minutes and use the remaining 20 minutes to do something in associates. Let me attend to this question. Any other question? Let's see 2 minutes so that we can go to the associates. Two minutes, let me attend to your question. Okay, in the absence of no question, let's go to next. Let's see how far we can go. Then we continue from. Let's take associate. Let's take associate. Question 3. Ida. Question 3. Ida is a public listed company acquiring the following investment. On October 2011, that is the date of acquisition. (2011), 72 million shares in Salvador for immediate cash payment of $195 million. either agree to pay further consideration on 30th September 2012. With this information, 72 million shares in Salvador. So out of how many? For me to determine the type of investment so that I can open everything. I will now go to the shares. I will go to the share capital. Salvador 120. I will convert it to get the group structure. Look at it. Okay. 60 NCI 40. Let's see. How do we get this 60%? This is the work. Okay, let's see how they get the 60%. Oh, okay, was not stated, no problem. I know that total numbers of shares in subsidiary equals to values of shares all over nominal value. He has 120 and he bought 72 at the nominal value of 1 naira. 1 naira divided by 120 give us 120. 72 over 120 times 100, that will give me 60%. So Salvador is a subsidiary of Hydra. It must be consolidated using the relevant standard, IFRS 3, IFRS 10. Then I will also look what type of investment do I have in Aragon. What type of investment do they have in Aragon? Is it on April 2012, 40 million shares in Aragon by way of share exchange of 2 shares in Hydra for each acquired shares in Aragon. Oh, he acquired 40 million shares. He used share exchange. My brothers and sisters, ECAN has not tested that before. All the 2 costs of investment we use to acquire subsidiary can also be used to acquire simple investment, can also be used to acquire associates. We can use DPAT. The same things that we apply to subsidiary will now follow suit. Because associate, we must first of all record that cost. Thereafter, we adjust for the post-acquisition changes. So don't be expect that associate will only give you cash. Please. Okay. 40 million out of how many? 100. 40 divided by 100 times 100, that is 40%. That's why they get the group structure, parent 60, NCI 40, associate 40. Good. Then we'll now start the question. For immediate cash payment of 195 million, I will ask the question, has it been recorded? Anytime you do cost of investment, always ask the question whether it has been recorded. I'll go through so that you know what to do. Either agree to pay a further consideration on 2012 of 49 million if post-acquisition profit of Salvador exceed agreed figure at that day. What type of consideration is this? Contingent consideration. Just like last diet, a specific target was given. It must be reassessed at the reporting date whether it meets target. It can only happen in 3 ways. Does it meet target? Is it below target? Is it exceed target? Let me show you what I'm saying so that you can know. It's a specific obligation given to the subsidiary before the money can be made. This is only 3 ways it can come in exam for the contingent consideration: meet target, below target, exceed target. If the question is silent at the reporting date, let me give an example of what I'm saying on contingent for you to get the clearer picture. On contingent consideration, there must be condition given to the subsidiary, and there must be agreement that if you meet this condition, I will pay you so. For example, if I said I'm going to buy you iPhone 12, if you pass your exam, all your papers in ICANN exam, what is the value of iPhone 12 today? 450,000. I have a liability on my head, 450. You have not written the exam at all. The exam has not been written. But when you meet the target, what do we mean? You write the exam. After writing the exam, I can release the result. You meet all the targets. That is meet target. You pass. I will say cost of investment, debit, 450,000. There is a liability on my own end. If it is more than 1 year, it is not current liability. If it is within 1 year of payment, current liability, I will credit 450,000. Second way, they release the results. You pass 4 out of 5, you only pay 1. I'll say you have tried. Instead of me paying you 450 that I promised, the fair value of the consideration we agree, 450, iPhone 12. I will not pay you 300. It's again to me. I will say cost of investment, debit, because it's happened at the date of acquisition, 450. I will not credit my retaining with the difference, because you have to pay 300 now, not 450, because it does not meet target. I will not say 450 minus 150, 300, 150. It's again to me. I will not credit my own retaining. Credit. That is what I'm saying here. Credit. The liability of 300 naira is still remaining. If it is in 1 year, current liability. If it's more than 1 year, not current. Credit. The third one, exceed target. The question will put it to us critically that because of the extraordinary performance, she is the best student in SFM, best student in CR. I say I'm going to pay. I say I promise I'll pay 450. There must be additional payments that will be specified by the parent in the question. Always note this. There must be additional payments that will be specified in the question for being extraordinary performance. You will see it. Instead of paying you 450, I say I will pay you 550. Cost of investment, I will debit. My own retail earning for the 450, I will debit because it's a loss to me again for paying additional 100,000. I will see debit my retail earning 100. If I'm paying more than 1 year, current liability credit, more than 1 year, I will credit. Now, look at this one. You will tell me where does it fall into before we go to the next one. Let's take Bola question. I want to show you. You tell me where does it fall to. Okay. In addition of the cash consideration, Bola will pay a further amount in cash as at 30th September is 2016 or 2017, if Abode returns to probability by that date, the value of this contingent consideration at date of acquisition was estimated to be 1.8 at the date of acquisition. But as at 30th September 2016, in light of the continued losses, the value was estimated to be only 1.5. Class, I'm asking you, where does it fall into those three arrows? Where does it, and what is the accounting entry to pass? I'm asking you, on the contingent consideration, where does it fall? Because you have even told, you will see the clause, if he returns to profitability, if Abode returns to profitability by that date, if condition that to be met, say if you pass, I'm going to give FCA 2 million naira. It's a condition. If you pass, it's a, you have not written the exam. Below target, yes, below target. Thank you, Madam Adenike, for the accounting entry. Now, let's now go back to what Ida. I want to tell me, where does it fall into? Now, Ida agreed to pay further consideration on 30 September 2012 of 49 million. If post-acquisition profit of Salvador exceed agreed figure at that day, Ida has not accounted for this payment. I don't believe we should be paying. However, Salvador have now exceeded the agreed amount. Now, where does it fall into out of these three? Read within the lines. Where does it fall into? When Olubimi said exceed targets, don't forget, if they did not specify in the question, if it is not specified in the question that they is below or above target, they did not say anything at the reporting date. At the date we are reporting, it means meet target. Meet target. Meet target. Okay. Okay, Shema. Now, okay, exceed target. It is not exceed target. This is the mistake people normally do on exceed target. There must be additional promise by the parent that is going to still pay additional money. If you look at this question, He does not say he's going to pay additional money. He just, yes, Mumbo. Ade agreed to pay further consideration on 30 of 49 million. If the post-acquisition profit of Exado, this is the contingent consideration, the agreement they had, I'll pay 49 million. But if you read the question, they say, however, Exado profit has now exceeded the agreed amount, but he does not promise to pay further money, even though he has agreed, I exceed the money, I promise. That means it's only what meet target. Don't forget this. On contingent consideration, exceed target. They will say clearly in the question, like this question. You see, if he said, however, Salvador will now pay additional 1 million for the extraordinary performance. That is what exceed target. Please, they used to play this prank. Yes, it is meet target. They used to play this prank very well. We only have 3 minutes more. I think these are for, yes. Online in my, yes, okay. Well, is there another question? Because we only have 3 minutes. Maybe we'll start from here because we have so many things to do. By God's grace, we are going to do something reasonable within this 1 month. I'm very sure of that. Is there any question before we call it a day? Okay, somebody have notified me. It is 3 minutes to the end of the class, please. Is there 2 minutes now? Do you have any question? Then if you can see private chat me. My number is 080 240 340. You can shout me. So 080 240 340 is 03. Have a wonderful night. Stay blessed. We will see next time. Thank you. Have a wonderful night. So, my Prof Adesua, it's a privilege having you on the platform. Thank you. You can now close the class.